Hi guys.
Just thought I'd take you through a few trades that I took this morning on the DAX. This is in front of you, the DAX 1 minute chart, and I'm going to talk you through the trades and also in relation to the double tops and double bottoms that appeared on the chart. And I recently did a video that showed you how you could use double tops and double bottoms to make a living from trading, and I hope that this video will illustrate to you how I use double tops, how I use double bottoms, how I trade them, how I set my targets, and how you can replicate this and use the knowledge from my videos and from my tuition to enable you to make money from trading. So let me introduce you first of all to the chart. So at the top of the chart we've got the equity curve just showing the money that I made from the trades. In the middle, obviously, the candlestick chart, and at the bottom this is the MACD indicator, and it's the MACD indicator with a 6 moving average rather than the standard 9 moving average on it, because I find that it reacts more quickly to the price action and is more effective when you are trading things like double tops and double bottoms. So let me talk you through what was going on the chart, and we'll start, there's quite a lot on it, so we'll start from the left and move over to the right. So you can see this is 8 o'clock in the morning. This is when the market opens on the DAX, and you can see the market, these are the moving averages here. We've got the 20 moving average and the 6 moving average being the blue, faint blue line that you've got here. And you can see the moving averages are pointing up and prices above the moving averages, so we know that the market has been rising for a period of time. So coming to the open, big jump upwards, and the market makes a higher high, it makes a higher low, and then it makes another high, which is actually a higher high. So this was the first high, this is the second high, higher high, and then it makes a low. Okay, so this is a lower low. This low here, or here, is lower than this low here. And so that always puts me on alert. When a market's trending upwards, it will make higher highs and higher lows. When a market is trending downwards, it will make lower lows and lower highs. So high, higher low, higher high, and then a lower low, which means that I'm on alert at this point in time. Effectively, the market's in a trading range, and actually if you look through all of the price action here, this is a trading range type of market. Lots of green, lots of red, alternate bars, lots of spikes on the end of bars here. And so when a market's in a trading range rather than a trend, what you expect is that it reaches the tops and it doesn't go up any further, it starts going down. It reaches the bottoms and it doesn't go down any further, it starts going up. It means basically when the market's in a trading range that neither the buyers or the sellers have got any long-term control, and that the balance of power is alternating between the buyers and the sellers. So the sellers step in when the market is at the top of the trading range, and the buyers step in when the market is at the bottom of the trading range. So the buyers will come in, and if you say, let's say this is the middle of the range here, the buyers will step in when the market goes below this level, and the sellers will exit. So what I mean by that is the market goes up, the buyers exit up here because they've got their profit, and the sellers step in. The sellers step in and it gets down here to this level, and the sellers will exit their positions, therefore buying back their shorts, and they will be joined by the buyers, the bulls, who step in and buy. Gets to the top and the bulls start exiting their long positions, which means they sell, and they're joined by the sellers, and the sellers, the people going short, will sell in this area here because it reached this top. So that's what happens in a trading range. There's a balance, a good balance between buyers and sellers, and the market basically fluctuates between highs and lows with lots of alternate bars, lots of green, lots of red bars. And when you're trading in trading ranges, what you're looking for is you're looking for weakness at the top, which indicates that the buyers have given up trying to push the market higher, and you're looking for weakness at the bottom, which means that the sellers have given up trying to push the market any further downwards. And the weakness often represents itself in the market's always going up and it's going down, and it finds support in buyers when it goes down, and it finds resistance in sellers. This is support and resistance when it reaches the tops, and you're looking for weakness at the tops, which means that when the market makes a high, which is a higher high, and then comes back down and fails to make a higher high, fails to reach the same level as this, then what you've got is weakness. You've got weakness, which means that the buyers are giving up, they're selling off their positions, and when that happens, the sellers who are sitting on the sideline, the people who want to go short, the traders who want to bring the market back down, will step in, and the two types of orders, that's the sellers going short and the buyers selling their long positions, those two types of orders will force the market down. So what you got here is you got a double top. Market went up very strongly, and then the buyers gave up. It made a lower high here, and the market started coming down. So you can see it in here. Higher high, market comes down. This is the middle of the double top. Market goes back up, fails to make a new high, and it comes down. And when it closes below the middle here of the double top, first top, second top, then you've got a potential trade. So quite often with these type of trades, I like to watch for this bounce. So this is the close. These are the closes at the middle, or this is the close in the middle of the double top. I like the market to come up and test this level and start falling, and we got a very, I don't know whether you can see it clearly, but you got a very small candlestick in there. And when you get a big candlestick followed by a small candlestick, very small body, almost can't see it, it's that small. When the market then breaks the low of that small bar, that's weakness in there. It's the market failed to go above the 20 and the 8 exponential moving averages, and so I entered my first trade, number one, entered my first trade short just underneath that very small doji bar there. And what I'm looking for then with a double top trade is high, middle of the double top, second high. I'm looking for a target of a minimum of the low of the middle of the pattern to the highest high, so that amount there. And that actually corresponded on this occasion with this low here. So as I said, in trading ranges, the sellers, people going short, will keep selling until it reaches a previous low, and then they'll pause and stop selling and possibly take profits. So I'd expect the market to come down to this level and then bounce, which is exactly what it did. And I exited at the close of this red bar here, which was at least 1-to-1 risk to reward, so 1 and 1, and so a good trade. I entered here, got out here, just over 1-to-1. Okay, so then the market went back up and it tested this low here, and it was forcing its way down, but there was no real conviction in here, just red, green, red, green, red, green. And what was happening here was we were at a round number level, 11,400, and also at the pivot level, the pivot point level, which is effectively a value level for buyers and sellers based on yesterday's price action, the highs, the lows, and the closes from yesterday. So you'd expect the market to test this level, 11,400, and also reach the pivot before going back up. And I was watching closely what was happening down here as it was doing that. Market came down, went up, 2 green bars, came down, failed to make a lower low, and then bounced upwards. So came down, made a low, went up, formed the middle of the double bottom here, and this is a micro double bottom, very, very small bottom, just 4 or 5 bars in it. Came down again, this bar here, and it made a higher close, just about see it. And then there's a big strong engulfing candlestick here. The body of this green one here engulfs the body of the red one here. And so that was a sign that the buyers were stepping in and were about to take control. So you got a double bottom trade here. Because it's a micro double bottom, and because these pivot levels act as magnets, quite often, you know, you've got a target on this one, this particular trade, of between here at the high of the middle of the double bottom and this low here. So this, which would have meant that you would be getting out here. You know, there's no real value in taking that particular trade. The gain, the potential gain's not really big enough for me. And also you've got these lows here, which the market could easily have bounced down from. And then it's a lottery really as to whether it takes you out with your protective stop at the bottom here, whether it takes you out and then bounces up, or you know, does it carry on upwards? And so I prefer to wait. I prefer to wait to see what happens. And the market came up, came back down, bounced, and when it went above these highs here, this corresponds with this level here, you've got a breakout, and that's where I entered my second trade. So on the back of this micro double bottom, after I'd seen evidence that I thought the market was rejecting the 11,400 level and moving upwards, it came right down to 11,400, left a spike, and I entered here, came back down, just tested these highs, but again, this is resistance along the top of these highs here. Market goes above the resistance strongly, comes back down, and that same level here acts as support. Prices go up. And so the target for my trade here, entering here, the target was obvious, the middle of the double top here. Well, this level here really. These two, this is Confluence. You know, this is a level where the sellers kept stepping in here, sellers stepping in at this level. So you get a big engulfing candlestick here, massive bar, and I exited at the close of that bar. Then lack of conviction, a very small doji bar after that, and guess what? The sellers are taking control. We're above the middle of the value, the overall value area in here, and the sellers started selling back down to test the 11,400 level and the pivot again. So you've got high, market comes down, lower high, and as soon as the market starts with conviction going below the 8 and the 20 exponential moving averages, I got in below these two pin bars here. Bullish pin bar followed by a bearish pin bar, so pin bar with a green body followed by a pin bar with a red body, and as soon as it went below that, I was in and I went short, and the market came back, tested these highs here, didn't quite go high enough. My stop was just above this high here, didn't quite go high enough to take me out, and you've got a high, middle, lower high. As soon as the market goes below these levels here, it's going down to the pivot, and it went down. And so the target for this particular trade, where was it? Well, it's in a trading range, so we're looking for the buyers to potentially step in at previous lows. This was the previous low, and so I actually got out. I was hoping this one would come right down, but it didn't. It went back up and closed at the pivot level, and so I got out on the close of this big down bar here. You can see that two double tops, two double bottoms in these trades here, and you can see that these double tops and double bottoms are replicated in the action of the fast line on the MACD line, and you can see here high, second high, market goes down, low, second low, market goes up, high, second high goes below there, market goes down, high, second high, lower high. As soon as it goes below that level there, market goes down. So you can see the price action. It's been replicated, if you like, in a momentum manner using a momentum indicator. And that's what I'm talking about when I'm talking about Confluence. The three things that I look for in my trades are context, content and confluence. So context is, what's the market doing? Well, the market's in a trading range. Where are the highs? Where are the lows? You can see them. The content, which is what are the candlesticks doing? I've got a double top here, I've got a double bottom here, double top here, double top here. And confluence, which is what other things are telling me the same things as the content in the candlesticks. Well, I've got confluence from my MACD indicator here. So 3 trades this morning, 3 winners. Excellent 100% record this morning. Isn't always like that with trading, but the aim is to overall make a good profit. And I think you can do that by identifying double tops, double bottoms in this particular way, looking for the context, looking for the content and looking for the confluence. I do hope that you've found this useful, and if you're interested in learning more, then go ahead and subscribe. Got plenty more videos on the way. My name's Anthony Beardsall. Thanks ever so much for joining me, and I'll see you on the next one. Bye for now.